Shri Guru Namaha children. Today we are going to see the lesson capital market. Okay, capital market lessons. You can see so many companies are coming, isn't it? The term capital refers to the facilities and institutional arrangement through the long-term funds. So money market last class we saw that is only for short-term funds. For starting industry in the sense, you need more amount, huge amount you need. So that capital market uh, will provide long-term funds. Okay, both debt and equity are raised and invested. It consists of a series of channels through the saving of the community are made available for industrial and commercial enterprises and for the public in general. In direct, these saving into their most productive use, lending to the growth and development of the economy. The capital market consists of development banks, commercial banks, and stock exchanges. An ideal capital market is one where finance is available at reasonable cost. The process of economic development is facilitated by the existence of a well-functioning capital market. This capital market will provide huge funds, I said. So long-term funds they will provide. So what the industries or any other big institutions need funds, they can approach this capital market. Okay, meaning and definition. Capital is market is a market where buyer and seller engages in trade of financial securities like bonds and stocks. So capital markets in this the main thing is stock exchange. So they were buying and selling the securities. Okay, so if, so many financial institutions or so many business trading people they were engaged in this security market. Okay, the buying and selling is undertaken by participants such as individual and institutions. Capital markets forms an important core of a country's financial system. So, capital market one day will provide more financial assistance to the government or individual or a firm. Capital market can be defined as a market for borrowing and lending of long-term capital funds required by business enterprises. Capital market offers an ideal source of external finance. It refers to all the facilities and the institutional arrangement for borrowing and lending medium-term and long-term funds. Like any market, the capital market is also composed of who demands funds and those who supply funds. So those who are lending, they can go and get. The borrowers will be there. So the capital market offers an ideal source of external finance. Okay, next, we are going to see the definition. According to Arun K. Datta, capital market may be defined as a complex institutions investment and practice with established link between the demand for the supply of different type of capital goods. See what Datta is saying, what the capital market is a complex of institution. It is a complex, it is a building. Okay. Investment and practice with established link between. So many people will establish, so many people are linked between the demand and supply of different type of capital gains. Now we are going to see the characteristics of capital market. Following are the nature and characteristics of capital market. Securities market. Dealing in a capital market are done through the securities like shares, debentures, etc. The capital market is thus called security market. So capital market is always known as security market only. So what are the securities they are selling there? This comes under this market. Price. The price of the security is determined based on the demand and supply prevailing in the capital market for security. So how the demand will be, how the supply will be. It depends upon the supply and demand only. We are fixing the prices. Okay. And then who are all the participants in the capital market? There are many players in the capital market. The participants of the capital market include individuals, corporate sectors, government banks, and other financial institutions. All the people, all the individual people, or a corporate sector, or any other bank. Corporate sector will produce mass production, isn't it? So they need so many, huge amount of capital. That's why they are approaching this capital market. And then location. Capital markets is not confined to certain specific location, although it is true that part of the market are concentrated in certain well-known center known as stock exchange. It has its impact in the overall economy, wherever suppliers and users of the capital get together and do business. See this capital market having an individual place that is called as a stock exchange. They are only going and buying and selling the securities. Okay, and then capital get together and we can do business there. Market for financial assets. Capital market provides a transaction platform for long-term financial assets. So we will give long-term financial assets system. Okay. And then kind of capital market. There are two types of capital market. One is primary market, another one is secondary market. This primary market is a market that new issue of new financial clients. So new business companies are establishing in business. They will sell their shares and debentures through this primary market only. So that it is called a new issue market or primary market. The primary market deals with those securities which are issued to the public for the first time. That's why it is new issue market. In the primary market, borrowers exchange new financial securities for long-term funds. Thus, primary market facilitates capital formation. Okay, there are three ways by which a company may raise capital in a primary market. Yeah, so there are three types. They are raising the funds through the primary market. First one is public issue. The most common method of raising capital for new companies is through sale of securities to the public. It is called public. Directly they are selling to the public. That is why it is called as public issue. Okay. And then right issue. Already an existing employee is there, the existing shareholder is there. First they will give the securities to that particular person and then they will give to the new persons. Okay. So that is called as right issue. When an existing company wants to raise additional capital, securities are first offered to the existing shareholders on a preemptive basis. It is called right issue. And then private placement. Private placement is a way of selling securities privately to a small group of investors. Okay. And then secondary market. Whatever they sold in the primary market, and then that shares only they will be selling in the secondary market. Secondary market may be defined as a market of old securities. In the sense that securities which are previously issued in the primary market are traded here. Already they issued in the primary market and then only they are selling in the secondary market. The trading takes place between investor who follows the original issue in the primary market. It covers both stock exchange and over-the-counter market. So all these things they are selling the securities. Functions and importance of capital market. Capital market has a crucial significance of capital formation. For speedy economic development, adequate capital formation is necessary. The significance of capital market is economic development is explained below. See what is the functions of the capital market. Saving and capital formation. It is a capital market. Various types of securities help to mobilize savings from various sectors of population. The twin features of reasonable returns and liquidity in the stock exchange are definite incentives to the people to invest in securities. This accelerates the capital formation in the country. See, it is motivating the people to cultivate the habit in their saving habits. And then those who are having a surplus funds, they can invest in the capital market. And then those who are needed, those who need, they can get the funds from the capital market. Okay. So the permanent capital, the existence of the capital market stock exchanges enables companies to raise their permanent capital. The investors cannot commit their funds for the permanent period, but companies required fund permanently. The stock exchange resolves their dash and interest by offering an opportunity to investors to buy or sell their securities, while permanent capital with the company remains unaffected. So it is routine. Automatically, they will be getting the continuous capital because somebody will buy the security, somebody will sell the securities on and off, and it will happen. So automatically, it will be a routine thing. So the permanent capital with the company remains unaffected. It will not affect the company. Industrial growth. The stock exchange is the central market through which resources are transferred to the industrial sector of the company. The existence of such an institution encourages people to invest in productive channels. Thus, it stimulates industrial growth and economic development of the country by mobilizing funds for investment in the corporate sector. See, Automatically, this capital market is giving more fund for the public so that the industries can easily get growth. Okay, automatically they are creating continuous flow of fund. That's why the industries and economic also will develop. Ready and continuous market. Any time you can go and get the security. The stock exchange provides a central convenient place where buyers and sellers can easily purchase and sell securities. Easy marketability and investment in securities more liquid as compared to other assets. So compared to other assets, you can immediately get the liquidation of the amount. Okay, anytime you can go and buy the securities or you can sell the securities. Reliable guide to performance. The capital market serves as a reliable guide to the performance and financial portion of the market, and thereby promotes efficiency. So automatically they can show their efficiency. The company can promote themselves. Okay, the capital market serves as a reliable guidance. Okay, the proper channelization of funds. The prevailing market price of the security and relative yield are the guiding factor for the people to channelize their funds in a particular company. This ensures effective utilization of funds in their public interest. So automatically, whatever fund they are collecting, they are using as a they are mobilizing their fund in a correct way. Okay, so the guiding factor for the people to channelize their fund in a particular company. So the company will also get benefit, and then the people also those who are investing they can also get benefit. Provision for variety of services. The financial institutions functioning in the capital market provide a variety of services such as grant of long term, medium term loan to entrepreneurs, provisions of underwriting facility, assistance in promotion of companies, participation in equity capital, and then giving expert advice. So they are giving more advice to the people how to invest in the security market, and then underwriters will be there. Underwriters in this is guarantee, they will give guarantee, and then assistance in promotion of companies. So everybody is giving idea, and then they are giving support to the people in the how to invest in the capital market, and then development of backward areas. So the capital market provides funds for projects in backward areas. This facilitates economic development of the backward areas. Long-term funds are also provided for development projects in backward and rural areas. You know very well the private sectors are not, they will never go to the backward areas, they will never do business in anything. But this capital market is providing fund for a project for doing projects in backward areas. So automatically that place is also getting developed. Okay. So the long-term funds also provided for development project in backward and rural areas. Foreign capital. The capital market possibles to generate foreign capital. Indian firms are able to generate capital funds from overseas market to buy way of bonds and other securities. Government has liberalized foreign direct investment in the country. This not only brings in foreign capital but also foreign technology, which is important for economic development of the country. See, you know very well. So many companies are foreign companies we are introducing, and then so many companies are coming here and doing business here, and then automatically we are getting our investment, and then we can also go and invest in some other country. So this only brings a foreign capital and also brings foreign technology also. Okay, automatically our company, our Indian economy also will develop through this foreign investments. Easy liquidity. With the help of secondary market, investors can sell off their holding and convert them into liquid cash. Commercial banks also allow investors to withdraw their deposit and when they are in need of funds. See this easy liquidity is whenever we need, we can go and sell our securities. And then the commercial banks, what they are doing, if you are buying some security receipts, they are giving loans also. If you are pledging in the bank, you can get loans also. Okay, so then whenever they need it, you can get funds from the banks also. Okay, and then next we are going to see the Indian capital market evolution and growth, how it formed. Okay, so the period between 1947 and 1973 marked the development and infrastructure for the capital market. During this period, a network of the development financial institutions such as IFCI, ICICI, IDBI, and UTA, SFC, and ISDS were established. These international institutions strengthen the capital market. See, these are all the industrial development banks. So after this industrial development came into existence, only our capital market has grown very well. Okay, so the growth of the capital market is very much high. So during the period between 1980 and 1992, debenture emerged as a powerful instrument. So after that only they introduced the debentures. Debenture is a loan, isn't it? So the company is getting loan from the public. That is called as debentures. Resources mobilization in the primary market. The public sector bonds were introduced. A number of stock exchanges came into existence. There was a momentous growth in the secondary market. So after that only, after the debenture introduced, no, then only the capital market was grown. Okay, in the secondary market, the momentous growth happened. Okay, again. CB emerged as effective regulatory body of the primary and secondary markets and offered a measure of protection to small investors. New financial services such as credit rating was introduced. And the CB is a Security Exchange Board of India. It is a regulatory body. It regulates the stock exchange. Okay, so all the controls, everything will be comes under CB only. A number of committees were constituted in order to suggest measures to revamp and restructure the working of the secondary market and causes buoyancy in the primary market. Some of these committees were Committee on Organization and Management of Stock Exchange, Working Group of the Development of the Capital Market, a study group for guidelines relating to valuation and new instruments, a high-powered study group on establishment of new stock exchange, a committee on trading in public sector bonds and units of mutual funds. See what they did, no, they after this CB came, no, a committee was formed and then everything has regularized. Okay, so they will take care of the primary and secondary market and then the committee has managed everything. And then stock exchange, okay, and then working group of development of the capital market and a study group of guidelines relating to the valuation of new instruments and the high-powered study group of establishment of new stock exchange, the Committee of Trading of Public Sector Bonds and Units of Mutual Funds, everything has established. Okay. And then new financial institutions. New financial institutions, some different institutions also came. A number of institutions of finance have been established to cater to the credit requirements of various segments of the industry and need. A brief outline of these institutions is presented below. So many institutions came into existence and then they started giving the credit requirements whatever they needed. Venture fund institution. The venture capital financial is a form of equity financial designed especially for funding new and innovative projects. So this venture fund, no, who are all introducing a new project, new ideas, new innovations, they were providing a credit facility for this particular purpose project. Venture capital funds bring into force a high technology project which are converted into commercial production. So high technology products, whether they are used in business, they can get this project and then they will do the project and with the help of this fund. And then many specialized financial institutions have promoted their own venture capital funds. They include Risk Capital Foundation of IFCA, Venture Fund of IDBA, ISDBA, Technology Development of Infrastructure Corporation India, and others. So many of them are giving a fund for this venture fund. Okay, so these banks and institutions and financial institutions gave a fund for this particular purpose. And then mutual funds. Financial institutions that provide facilities for channeling saving for small investors into avenue of productive investment called mutual fund. This is very, very important. Okay, mutual fund in the sense, those are doing a small investors is there in the sense, they to develop them according to this, they can find out this mutual fund. Okay, a mutual fund company invests the fund pooled for shareholders and gives them the benefit for diversified investment portfolio and the reasonable return. So they will never get more returns, but it is good only. Okay. So specialized financial institutions like LIC, UTA, etc. Besides, commercial banks such as SBA and Canara Bank are carrying out the business of mutual funds. The benefits of mutual funds are high returns, easy liquidity, safety, and tax benefit to the investor. So, because the small investors only doing this business now, that's why the government is giving more benefits to this mutual fund. So, returns are high, and then easy liquidity. You can give, and then you can get the cash easily, and then safety and tax benefits are also you have. Factoring institutions. Factoring is the arrangement whereby the financial institutions provide financial accommodation on the basis of assignments. Sales of accounts receivable. The factoring institutions collect the book debt for, and on behalf of its clients. Some of the factoring institutions operating in India are SBI Factors and Commercial Service Private Limited and subsidiary of State Bank of India and Canara Bank Factors Limited, subsidiary of Canara Bank. So this factoring is nothing but, for example, a man is arranging, he is going to start a factoring business. We can the manufacturer will give all the products to the particular person, and then he will sell and give the products credit on credit basis. Okay, after he collected the amount and then he will pay to the manufacturer. Okay, so these help the SBA and commercial and other banks, also Canara Bank and other bank also doing this factoring facilities. Okay, and then over-the-counter exchange of India. The OTCEI was set up by the premier financial institution to allow the trading of securities across the electronic counters through the country. It addresses some specific problems of both investors and medium-sized companies. Some of the greatest strength of OTCEI are transparency of transportation and transaction, quick deal and faster settlement and better liquidity. See, it is a online basis, electronic basis counter throughout the country we have. Its main thing is the both investors and medium-sized companies they can sort out their problems through this. Okay, some of the greatest strength is it is very transparent, and then you can easily deal with this securities through this, and then you can get faster settlement and better liquidity. Okay, and then National Stock Exchange of India (NSEI) are established in 1992 to function as the model stock exchange. The exchange aims at providing the advantages of nationwide electronic screen-based scriptless and flowless trading system in securities. The institution is expected to allow for all an efficient and transparent system of securities trading. See why all those things are they introduced, so it should be transparent. The public should know everything. So that's why they have introduced all the electronic screen-based scriptless and flowless system. Okay, so this NSEI also they introduced in 1992. And the National Clearance and Depository System. Under the scriptless trading system, settlement of transactions relating to securities take place through a book entry. The entire scriptless trading system comprises the following three segments. What are the segments they are having? National Trade Comparison and Reporting System, which prescribes the terms and conditions of contract of the security market. So, how to follow? What are the terms and conditions? Everything they have mentioned in that. And the National Clearing System, which aims at determining the net cash and stock liability for each broker on the settlement date. So, what are the liabilities the broker is having, and then how to pay the net cash? Everything they have determined clearly. National Depository System, which arranges to provide for the transfer of ownership of securities in exchange on payment by book entry on electronic ledger without any physical movement or transfer. See, nowadays everything comes under the electronic thing, and then they are doing all the transactions through online. So that's why they will reduce the manual work. Okay, the payment of book entry is electronic ledger without any physical movement or transfer date. So physical movement will not be there. Everything will come under electronic ledger only. National Security Depositories Limited was set up in 1996 for achieving the time-bound dematerialization as well as the rematerialization of shares. Already I said I think the dematerialization in the sense they are taking their securities back, and then they will give an account, a demat account. Through that account only you can buy and sell the securities. So, the establishment of NSDL is expected to alleviate the problems of post-trade transaction in the secondary market. Stock Holding Corporation of India Limited. Stock Holding Corporation of India Limited aims at serving as a central security depository in respect of transaction on stock exchanges. The corporation also takes up the administration of clearing functions the national level. This stock exchange, what they are doing, they are transferring what are the transactions they are doing, everything through the stock exchange only they will do. This corporation will take up the administration work and clearing functions at the national level. They will do all the stock holding works. Okay. And then foreign exchange market. Foreign exchange market others foreign exchange trading. It is the largest and most liquid market in the world with the average traded value for more than $5,000 trillion per day. It includes all the currencies in the world and any individual company or country can participate in it. So foreign exchange market is all the countries will participate. All the sales and securities, shares and securities they will be selling there and they are buying there. Okay, all the countries can participate or individual also can participate. And then commodity market. There are two types of commodity markets we are having. One is hard commodities, another one is soft commodities. Hard commodities in the sense are raw materials typically mined such as gold, oil, rubber, iron, ore, and like that. And then soft commodities are typically grown agriculture primary products such as wheat, cotton, coffee, and sugar. These are the two type of commodity that they are selling. Okay, so these are the two types of commodity markets. And derivative markets. Derivative market facilities, the trading in the facility financial institutions such as future contract and options used to help control financial risk. So future contract means in future I will do the business with you. Like that they will do some agreements. The instruments derive their value mostly from the value of an underlying assets that can come in many forms: stocks, bonds, commodities, currencies, or mortgages. These are all the derivative markets. In future contract only they will do all these things. Okay, children, do you understand?